All right. Hello, everybody. Looks like we're all up and running. Good afternoon to my Eastern time folks, and good late morning to those of you in any other time zones. And welcome into our weekly webinars hosted here by Hendricks Wealth and Estate Management. Um, Thank you all for taking time out of your busy days, maybe taking time out of your lunch hours to join with me today. Join with me on screen today. Looks like this camera might be off for a second. Is our owner Jim Hendricks, um, and I am Tom Anderson. There he is, one of our newest advisors on staff here at Hendricks Wealth. As for some housekeeping items before we get rolling, you should see a Q&A section right down in the bottom of your Ring Central screen. So if you have any questions during the webinar, just feel free to drop those down in that chat, and I'll look to answer those at the end of the webinar. Um, but today I'm going to be talking about financial essentials every new homeowner should know before you buy. Some of you in here might maybe looking towards buying your first home. Maybe some of you already have a home. Maybe you're looking for another and need a refresher. Maybe some of you are just torn between whether you should keep renting or you should purchase. Um, Rates are starting to come down. Prices in some areas are falling. So now might be a good time to look and learn and see all about that home buying journey if you're somebody who may be torn between continuing to rent. Maybe you're somebody getting serious about owning your own home. I know it can be an intimidating journey, absolutely, but it can definitely be a rewarding one as well, as long as you do it right. And that's what we'll be talking about today. Getting ready to buy a home. Today, what we're really just focused on is getting ready to buy a home, not touring the homes, not scrolling listings online, but that financial preparation that should happen before you start looking. Buying a home obviously is an emotional decision and it's a very big one, um, but it's a financial decision first and foremost. And where people prepare properly, that's when they tend to save money, avoid stress, and have a lot far fewer regrets further down the road. So before the search begins, there are going to be a couple financial checkpoints that really matter. Having an emergency fund that still exists after the down payment, obviously that can sound really scary. I know down payments are big, but in that first year of owning a new home, a lot of surprises might come up. You do not want to have to go into more debt just to extinguish those fires. So being prepared with a solid emergency fund is just a great step to protect yourself. Next, getting that monthly debt manageable. Focus on paying down those high interest debts first, since the last thing you want when you're first owning a home is to be swamped with high interest debt. Um, Next is having a stable income, ideally looking towards the last couple years. Um, Obviously, some lenders and I mean, just lifestyle will help you get away with having less, but obviously it'll just be harder um, the newer into a steady income you are. And just having a realistic plan to stay in that home for at least 5 years. Now, you might ask me why 5 years? Um, Obviously, buying a new home comes with a lot of upfront costs. There's closing costs, inspections, appraisals, even moving expenses. And on average, these costs can vary between 5 to 7% of that purchase price. So if you sell too soon, you may never recover that money. Um, and basically, you're just then paying a transaction fee instead of actually building equity towards something. That 5 year mark is not really a hard rule. Obviously, life happens, things can change. But just thinking in terms of those 5 years can help you make just a better, smarter financial decision. Can you break even in less time? Sure, maybe 3 years. But just planning on five or more is a good start. And one thing I'll say here is most home buying mistakes happen before you ever get to the first showing. And obviously, it's not an exciting part, but this is where good decisions can be made. When we start talking about getting ready to get into a new home, obviously, what comes with that is you may need a loan. And with a loan, your credit score plays a much bigger role than a lot of people realize. This doesn't just affect whether you get approved and whether you can get a loan. It affects your interest rate and it impacts that cost over time and your monthly cost. Um, some things to look for is your payment history and balances on your credit really matter the most, especially to lenders. Having that high utilization on credit cards or loan balances, that's going to be a big flag towards those lenders. Um, and right before buying a home, that's not going to be the time to open a bunch of new lines of credit, make any big purchases that'll be put on payment plans, things like that. And here's something that, I mean, surprises a lot of home time buyers. Even small changes in your credit score can have a really big impact on those mortgage costs that you'll have. I mean, just a generic example, if you're imagining two home buyers, both are looking at a $300,000 house. Buyer A has a credit score of 720, buyer B has a credit score of 680. I mean, that's only a 40-point difference, but that might mean an interest rate difference of 0.5%, maybe a full percent. And on a 30-year loan, maybe that percent doesn't sound like much, but that can be, an additional $100, $200, $300 each month that you could be putting somewhere else just by that 40-point credit score difference. So just doing everything you can to boost that credit prior to applying for a mortgage, that can help you save tens of thousands of dollars over the long term. And last but not least, hard pulls, they can be a relatively small part of lenders' decision-making process. But if there's too many lines of credit being opened the year or two before applying for a mortgage, um, they can have a pretty negative correlation on your rate overall. And you don't need perfect credit, absolutely not. But you do need to have prepared credit and just getting as close to that as you can before getting that mortgage. Next is the true cost of buying a home. We listen to Dave Ramsey quite a bit, and small quotes on the screen. A budget is telling your money where to go instead of wondering where it went. And one of the biggest surprises for first-time home buyers is just how many costs exist beyond the principal and interest of the mortgage payment itself. Upfront, obviously, you'll have the down payment, closing costs, inspections, appraisals, moving. Um, those can add up, but also you can't neglect to remember about the ongoing costs as well. There's going to be property taxes, you'll have insurance, maintenance, maybe HOA fees depending on where you buy a home, um, and you might have PMI if your down payment is less than 20%. So if we're not even including utilities, these can start to add up. And this is why I say your mortgage payment is not your housing cost. So if you can get approved for a $3,000 a month loan, don't forget that that $3,000 can add up a lot faster than you might think, with all this other stuff on top of that. So when we look at how much house you should buy, there's really a big misconception in home buying, and that's the difference between loan approval and affordability. Um, Not sure you'll believe me on this one, but lenders aren't in the business for making your life comfortable. They're in the business of just managing risk. When a lender approves your loan, they're looking at your income, your debt, your credit, other factors, and they say, we think you can pay this back. That doesn't mean that it's going to be comfortable for you to pay it back. Buying based purely on the maximum approval, this is going to stretch your budget pretty thin, limit your lifestyle, make those small surprises that might come up in the first year or first 10 years of owning a home. Just that'll make that a lot more stressful for you. So that's why I'd like to encourage people to think in terms of cash flow comfort, what payment actually feels manageable while still allowing you to save money, still allowing you to enjoy life, travel, and also be able to handle unexpected costs that come up. And just a good general rule of thumb is keeping those total housing costs, the mortgages, taxes, insurance, HOA, things like that, right around 25 to 30% of your monthly income. And obviously that number is not perfect for everybody. Some will be much higher, some might even be lower. But just trying to get to that point will help you get a little more flexibility so you're not living so much paycheck to paycheck in that new home. If you're going to remember one thing, remember the line, just because the bank approves it doesn't mean that your life is going to. And approval is about numbers, affordability is about your life. So when you make decisions based on comfort, home ownership is just going to be a lot more enjoyable and a lot more sustainable in the long run. Moving on to some mortgage basics. Obviously, I'll keep this a little bit simple. Just want to have you walk away understanding the key differences, what matters about these. First, there's going to be fixed versus adjustable rate mortgages. Fixed rate mortgage has the same interest rate for the whole life of the loan. These are pretty standard. I would say the majority of people get this. Your monthly payment is going to stay just about the same, and that's just great if you value stability, predictability. And an adjustable rate mortgage, this usually starts with a lower rate and it can change over a set period. And yes, adjustable rate mortgages still are a thing. People do still get them, especially in a high interest rate environment, because they offer a lower initial payment for a set period. Let's say that's 5, 6, 7 years before adjusting back to those market rates. And this is really targeted at people who plan to move or refinance before rates reset. But these carry significant risks, especially if rates, end up rising. Next would be looking at the terms of that mortgage. If it's a 15-year, maybe a 30-year term, a 15-year mortgage, obviously you'll pay it off faster and might have a little bit lower rate, so you'll pay less interest. But the downside is then your monthly payment is going to be higher. A 30-year mortgage, that's going to spread those payments out, make it a little more manageable month to month. You'll end up paying more interest over the life of the loan, of course, and that's just a trade-off between that cash flow flexibility and the total cost. A 30-year mortgage will have a interest rate that's lower, generally speaking, than what you could potentially earn investing your money. If you're getting a rate on your mortgage, let's say 5 to 7%, but your investments might be making 8 to 10, stretching out that loan might allow you to invest more in yourself and your future instead of actually just paying down the house as fast as you can, which can end up paying off over time. Let's briefly touch on PMI. PMI is private mortgage insurance. This comes up when your down payment is less than 20% of the home value, and then those lenders will require what's called PMI. Think of it basically as just an insurance for the lender in case you default. It can go away when you reach 20% equity on the home, but it can certainly be quite the headache in the meantime. On a $300,000 mortgage, PMI can vary between 0.5% and 1.5% of that original loan amount every year. And that could mean an extra $150 to $375 plus a month. So really the key takeaway here is just the lowest rate. It's not always going to be the best loan. The best loan is going to be the one that matches your cash flow, your lifestyle, and those long-term plans. Stability, flexibility, predictability, this can matter a lot more than just an interest rate. So now let's talk about some common mistakes I see a lot of first-time homebuyers make and why they can be so costly. First would be just draining those savings down to make that down payment. You start putting every dollar that you have into your house, especially at the down payment. Could sound responsible, but it can end up leaving you unprepared for those unexpected expenses. Maybe you have a broken appliance, an urgent repair, maybe even you temporarily lose your job. Obviously, when you're buying a home, you want to own a home and keep that financial cushion relatively intact. Next would be buying at the very top of your budget. We've already touched on this a little bit, but lenders obviously they'll approve you for a maximum amount. But just because you could afford it doesn't mean it's going to be comfortable for you. Third, opening a bunch of new credit before closing. Again, we kind of briefly touched on this, but this is just a big mistake people make. The new credit card, maybe a new car loan, big purchases. These things can impact your credit score and just make that overall mortgage payment higher for you in the long term. And then, finally, just forgetting about those long-term goals. Think about where you want to be in 5, 10, say 20 years. Um, will this home that you're trying to buy still support your savings, still support your retirement, support your ability to travel, maybe have a different career plan? Homes should support your future and your plans. They should not delay anything for you. So the main idea here is just buying a home is about more than just today's mortgage payment. Every choice that you make now can affect your life for many years to come. So the smartest buyers generally um, plan with that long game in mind. Then obviously, if you're getting ready to buy a home, who do I need to help me buy that home? Um, Buying a home really works best when you have just the right team involved early. Getting into a good realtor, uh, someone who can help you find the home, negotiate the price for you. Um, the lender, they're going to structure the financing for you, get you approved for a mortgage, um, hopefully get you lower rates. And then my role as a financial advisor would be to make sure that this purchase actually fits your life and your lifestyle. My job obviously it'd be to protect your long-term plan, not just help you get to closing, um, but make sure that you could still plan for your future even past such a great moment in your life, like buying your first home. And then next steps, before hopping on any websites, scrolling listings, before you go to an open house, before you fall in love with that beautiful white kitchen, um, the smartest next step would just be assessing your readiness. Can you afford this? And making sure that the purchase aligns with your goals. And having a short financial checkup now might prevent a long-term regret later on. Um, but yeah, that's just about it. Thank you all for being here. Looking ahead, we have a couple of things coming up in the upcoming weeks. Next week, we don't have a webinar, but the 3 weeks following, we will, and we should have one just about every week after that. January 28th, one of our financial advisors, Jim Madel, is having a webinar on turning your employee perks into wealth. February 4th, Sean Hendricks is having a webinar on how do trusts actually work. And then Dan Leitner on February 11th will be discussing paying off debt versus investing. And like I said, we'll have a little bit of time for Q&A. If there's any questions, feel free to put them in the chat, and me or either Jim Hendricks here will take to them and answer.
Yeah, there were a couple questions. Thanks, Tom. Tom did a great job of going over the whole process of the pre-buying, the time before you buy your home and trying to make sure you're making good financial strategy about buying a home. We actually really love it when clients come to us, or even prospective clients come to us before they get too far down the road in buying a home, because a financial planner, if nothing else, at least has a different frame of mind than your real estate broker or that your mortgage person might have in mind. Their incentives are a little different. Ours are to make sure you're making a good, sound, long-term decision, and theirs might be to get you in as much house as they can. So it's a really, really good idea to involve a financial planner in your home buying decision. And again, we really love when our clients come to us with those questions before they get too far down the road. And Tom did a good job explaining all that today. There were two questions during the presentation that I answered or addressed during the presentation. But if anybody has any additional questions right now, we're happy to try to answer those.
Yeah, I'm not seeing any in the chat. Did you see any on your end?
Nope. I think we've addressed the two that came in. So
Cool. Give you guys, a minute or so if there's anything lingering. We'll see.
yeah, and Dan's while that's coming, while we're waiting for any possible last minute questions to come in, when Dan Leitner gives his presentation about debt versus investing, as it relates to homeownership, a lot of times we will tell people not to make accelerated payments on their mortgages, because if they invest those same funds, they likely could end up with a better rate of return long term than they would get if versus the interest they'd save the interest expense they'd save by using those same dollars to make accelerated mortgage payments. So a good rule of thumb is if your mortgage is below 7%, if you're disciplined enough to invest those funds properly rather than paying off your mortgage, then you are likely to come out ahead. There's no blanket investment recommendation we can make there. But in general, 7% is a good break-even line when it comes to thinking about whether you should make accelerated mortgage payments or not. Okay, Tom, maybe close it up since we don't have any more questions that
Cool.
have come in here.
Yeah, looks like we are all good. So again, I just wanted to say thank you to everybody for taking the time out of your day to come attend. If you want to, request an appointment, maybe you're somebody who has questions about buying a home, we offer a full 1 hour consultation free. And feel free just to request an appointment with one of us. We have our Florida numbers here. There's our email. Our website is going to be www.hendrickswealth.com. There you can see all this information and any future events that we're having. Should be able to sign up on there. So again, thanks everybody, and hope you have a great rest of your day.
Thanks, everybody.
Bye.